Hi. So in this video, we're going to try and understand the basic tenets of evaluating a bank. How do you go and evaluate a bank? What are the key parameters that you have to keep in mind when you're looking at a particular bank? It's not a very exhaustive video. We are going to try and touch upon the core elements of the banking system and understand, what makes one bank better as compared to another bank, right? So let's begin with a very basic understanding of how does a bank work? How does the banking system basically operate? At its heart, the banking system is a very straightforward system where the bank is going to accept deposits from depositors. These are technically the sort of liabilities for the bank. And the bank will then use that money to extend loans to people who would need that money. So basically, take 100 rupees from depositors and give it out to people who need it in the context of those loans. This is how basically the banking system mobilizes the capital in the country or the economy from people who have that money to people who need that money. So that's a straightforward mechanism. However, there are a few issues with this model. If it was this simple, there are going to be challenges here. There are two broad challenges. The first challenge, depositor is somebody who's given you the money. So it's like a lender to the bank essentially, right? So when I deposit my money in the bank is supposed to safeguard it, right? In this environment, if a bank is functioning, technically speaking, there is no skin in the game for the bank. Somebody else's money being loaned out to a third person. If something goes wrong, it goes wrong. What does the bank really lose in that? So that's problem number one that comes into the picture. Even if the bank has the interest of the depositor completely in their heart, right? Even then, it's possible that some loans don't come back. So how do you ensure that things don't go bad there? In addition, if you take 100 rupees of deposits and you give out 100 rupees of loans, what do you do of the liquidity issue? So there are multiple issues that need to be addressed. Liquidity is one of them. A depositor can go tomorrow to the bank and say, please give me my money, right? Bank mana nahi kar sakta aapko paisa dene se. Technically, if you have your money in the bank has to give it to you. The second problem is skin in the game. Where is bank's own money into the game? That is there. And the third problem is risk management. Who's being given that loan has to be assessed clearly. To address these problems, the central banker of the country who controls the banking system, in India's case RBI, will come in and create certain regulations. Okay? Ab kya honge ye regulations? So the first regulation, and I'm using very basic ballpark simple numbers here to kind of get a sense of what these numbers are. I'm not getting into too much nitty-gritty here in terms of the exact way it works because it's a simple video, right? In the context of trying to put in skin in the game, what RBI stipulates is the bank has to have some of its own capital. Some of its own equity capital has to be put on the pedestal so that could be loaned out, right? So let's simplistically just assume that number is 10. So bank takes 100 of deposits and 10 of its own equity and goes and gives it out as loans, 110. That solves one of the problems, which is this skin in the game problem. Now there is skin in the game, and of course depositors are lenders for the bank. These are people who have given debt to the bank. So the order of precedence will be first for the depositor. The depositor will get paid first, right? Even if you recall most of the bank bailouts in India, in any kind of a bank bailout, the depositor is saved. If there is a problem, the equity holder goes out of the area in that context. So that's the idea behind this thing. This also sort of, because you put in skin in the game, solves what traditionally is commonly known as the principal agent problem. The bank is the agent who acts on the behalf of the principal, who's the depositor, and tries to generate a return on the money that the depositor has given to the bank. But of course, the bank will try to maximize its profits in this entire scenario, and that could cause a little bit of this manifestation of the principal agent problem, where the interests of the agent, which is the bank, is not really aligned well with the interests of the principal, who's the depositor, right? So there are safeguards for that as well as we go along. Equity kind of puts a little bit of skin in the game. One point to be noted here is that unlike some of the other industries, this industry starts with a debt to equity ratio of close to 10, sometimes even more, right? So it's a highly leveraged industry, and consequently it has to be a regulated industry. You wouldn't find 10 times debt to equity in a lot of the other industries, and if you do find it, you will see a lot of regulation coming into the picture, right? Now, how does the RBI solve the liquidity problem in this case? So You take money from depositors, you take money from equity holders, you pull that money in, that's 110 here, right? Now what the central bank will stipulate is some part of this money has to be put aside as reserves. There are two kinds of reserves. We would have heard the names CRR and SLR. Once again, just using ballpark numbers here to kind of make the point, not using the exact numbers that are there. So RBI will say whatever deposits you have, 4% of that has to be put as cash. CRR is cash reserve ratio, right? This is to tackle any immediate demand of cash, right? SLR would be approximately another 20 odd percent. I mean, the exact numbers are slightly different, but just to simplify it, let's say about 20% odd is the SLR, which is statutory liquidity ratio. This is money that is deposited or put or invested in very liquid bonds. What do you mean by very liquid bonds? You can offload them whenever you want. कभी भी बेच सकते हैं in bonds को, so that you get money back immediately. The idea of putting this approximate 25 rupees out of the 100 rupees of deposits that have come in as reserves is that it provides liquidity to the depositors. See, a bank also always works with a basic issue. If you look at the way the deposits come and the loans go out, deposits don't have a fixed term in mind. There could be term deposits, but usually are short term in nature. I can go tomorrow morning to my bank and take out money from the bank. That is there. Loans, on the other hand, are usually long term. I mean, people who need money would want it largely for longer term things. I mean, take a house or home loan, or a car loan, or a infrastructure loan to a corporate. Take all of those into account, and you'll find that these loans are typically going to be for a period of 3 years, going all the way up to 20 years, 25 years in certain cases, and so on and so forth. So there is an asset liability mismatch, which means your assets, which are your loans, are all long term. Your liabilities may be short term. The depositor could walk in tomorrow in the bank branch and say, please give me my money. The bank may not have money. There is a liquidity issue. To solve that, you keep these reserves, right? Now these reserves, obviously, because SLR is invested in bonds, it creates another income stream for the bank in the form of investment income that comes in. Correct? So that's this, and then you sort of loan out the remaining amount, which is 85, that goes out. So that's how the system works. For a minute, let's assume that we are in a zero interest rate environment, right? No interest rates, to keep it simple, right? So at the end of the year, the bank should get back 25, the bank should get back 85, the bank should repay 100, and the remaining 10 should go to the equity holder. No profit, no loss, assuming 0% interest on both sides of the equation. If there is an interest rate, the way the bank charges is the bank makes higher interest on loans, right? And the bank wants to pay lower interest on deposits. Correct? So that's the picture that is going to emerge out of how do you really look and evaluate banks as you go along. But that's we'll come back to that in a moment. Right? Now let's introduce this concept of non-performing loans or non-performing assets. What if you give a loan and it doesn't come back? Right? So the bank has given 80 rupees of loans. Let's say 5 don't come back. 85 rupees of loans have been given. 80 come back, 5 don't come back. Right? Assume the simple zero interest rate environment. You get 25 from here. You get 80 from here. How much is that? 105. Out of the 105, you pay 100 to the depositors. What are you left with? 5 on the equity. You started with 10, your equity is now down to 5. That is one of the reasons. How much is the NPA? 8 upon 5 upon 85 basically. What percentage of loans have become non-performing assets? NPA is non-performing asset or non-performing loans, NPLs. 5 upon 85 is going to be close to about what, 6%, approximately that, not even that, right? So at a 6% NPA level, the bank loses half of its equity value, right? And that's a problem. And that's exactly why, because in a highly leveraged environment, this is going to be a possibility. A, the banks are regulated. B, if you do see an NPA problem, there would be a sudden dip in terms of the bank's equity value. The stock prices will tumble. So tomorrow morning, suddenly, if a bank comes and announces that, okay, I have extra 2% NPA than what was announced earlier, the stock price is going to tumble pretty much significantly more than that 2% NPA number because of the leverage factor that comes into picture. Correct? So that's the construct of what what is there. Plus this doesn't stop there, because you need this equity to go and lend more money, because that's what the regulation says. The first time the regulation of equity came in, the idea was that you have to have a certain amount of capital to be able to extend a given amount of loans. If your capital gets wiped out, you can't give the loans even if you have the deposits, right? Now let's think about what is necessary to evaluate a bank. Basically the picture emerges in this scenario. You want to look at what is the cost of deposits, right? A bank that is able to raise deposits at a lower cost is going to have an advantage. So somebody who has a large network, somebody who has access to, let's say, the smaller cost deposits, some of the current accounts or savings accounts which don't necessarily have to pay too much interest. So any bank with a huge branch network that is spread in areas where you would get a lot of clientele would typically have access to low cost of deposits or lower cost deposits in the books, and that adds an advantage to the bank, right? Any bank that is able to raise equity at any given point of time, right? Some of the larger banks in India or well-respected banks in India, likes of HDFC Bank, can practically go and raise equity from markets at any point of time. There are there's always institutional demand. There are domestic and foreign institutions who would want to invest into this particular bank. So equity raising ability, is also a very, very big component of the entire scenario. Who are you giving your loans to? So are you getting, what is the return on these assets or loans that you have created, right? Are you getting a higher return on them? Are you getting a lower return on them? Remember, risk and return go hand in hand. So you also want to look at what is the risk here. When you're evaluating a bank, you want to see where has it given the loans and what is the process of identifying the risk. कितना risk ले रहा है बैंक, correct? अगर सडनली जाके एक पर्टिकुलर सेक्टर को बहुत सारा लोन दे दिया, लेट्स से आर्ग्यूमेंट से इफ रियल एस्टेट सेक्टर और स्टील सेक्टर इज इन ट्रबल एंड यू गिव अ लॉट ऑफ मनी टू दिस सेक्टर, दैट इज गोइंग टू बी अ चैलेंज. सो कितना रिस्क बैंक ने लिया है, कहाँ लोन दिया है, एंड उन लोन्स पे क्या रिटर्न एक्सपेक्टेड है, इज गोइंग टू बी अ क्रिटिकल component of your evaluation of the bank, right? So that forms the component in terms of your returns on the bank. And in terms of reserves, you want to see what kind of investment portfolio the bank holds, right? So is the bank sort of giving is making money when interest rates are sort of stable, or how much money does it lose when interest rates go up? All that component forms a part of the investment portfolio. There are obviously nuances to that in terms of are the bonds held for trading, or they are available for sale, or they are held for investment, held till maturity. Depending on them, the allocation and the investment income works. But the moot point or the simple point is, how good is your investment portfolio? What kind of bonds you have bought in? That is going to define the return on this. And that's in a nutshell pretty much the game. You need to see a bank, if the bank has access to low cost deposits. You need to see if the bank has sort of continuous demand of its equity in the markets. You want to see where has the bank lent money and what is the risk taken there. You want to see what kind of return the bank can generate with adequate risk management measures. For example, it is considered that retail loans given with proper underwriting are going to default less. Usually retail loans don't become systemic loans, systemic issues, unless there is a very big problem that is going in the economy, right? But corporate loans could be a problem if that sector goes into stress, right? As we said, let's say argument's sake, in the period of 2015 to 2018, steel sector was in trouble in India. Between 2018 and 2020, some of these infrastructure finance companies were in trouble in India, right? So you would have to see who that loan has been given to, and usually banks that have given loans to general retail customers at large have tend to do better in India in the recent past, or in the last couple of decades or so that we have seen. And then of course the investment portfolio that comes into the picture. The risk element is going to play out in terms of your non-performing assets evaluation. So you want to see what are the challenges there, how the bank is controlling that portion, and on an ongoing basis, these are the parameters that you evaluate for a bank: low cost of deposits, high return on assets with managed risk, continuous access to equity, and what are you doing on your bond portfolio on an ongoing basis. And plus, sometimes banks have other income also coming in, so you want to see if there are other areas where a bank makes a lot of income, like fee income, investment banking, and so on and so forth. But those, in a nutshell, are the core points that you would want to evaluate when you are evaluating a bank. That's it in this particular video. Thank you.